Good morning, options traders. Well, to kick off 2021, I thought it would be a good idea to revisit a topic that I've talked about in many different videos in various forms, but that is that options have a speed component to them. And because we have a lot of new traders in here and people learning about the stock market, it's a really easy trap to step into to say that, for example, I want to buy a call option because I think that the stock is going higher. Or I want to buy a put option because I think the price is heading lower. And they have to realize that when you're trading options, it is no longer an up-down game. Instead, there is a speed component to an option, and that's what causes so many traders to lose money, even though they're right about the stock's direction. So how can you improve your chances for making money? Well, to do that, you need to reduce the need for speed. So recall that stock is one-dimensional. And what I mean by that is that if you're trading shares of stock, you only need to determine if it's going up or down. That's it. If you think it's going up, you buy it. If you think it's going down, you sell it. Or perhaps take a short position. But the decision is super simple. It just comes down to one question. Do you think it's going up or down? And the reason for this is that stock always gains and loses dollar for dollar with itself. But that's not true for options. And this is why, once again, that so many people who are new to options end up losing money. Because they come from a stock trading background where the only decision that they had to make was up or down. And they carry this over into the options market and say, oh, I think the stock's going up, let me buy a call, and then they lose money and they can't figure out why. So the reason is that options are multidimensional. It's no longer an up-down game. So at a minimum, we have delta, gamma, theta, vega. Sometimes we even have to consider rho. But there's a lot of different dimensions that can add or subtract to an option's value, and therefore the decisions aren't so easy. If you get nothing else from this video, just understand that if you are trading options, it is no longer an up-down decision. Instead, it's about direction and speed. See, options need direction, just like you do in the stock market, but they also need speed. And this is because, for a number of reasons, you have gamma, you also have an expiration date. So not only do you need the stock to move in the correct direction, but it has to do so within a certain time frame. So if you don't understand these concepts and you're trading options, you can lose money even though you were correct about the stock's direction. So at a basic level, when you're trading options, you have to beat the extrinsic value or the time value. It's like an added premium over and above the stock price, and you have to make that up. That's another way of understanding why an option has a speed component to it. So for instance, let's say that the stock is trading for 100 and you buy the $100 call trading for 7. This is an at-the-money option, and that means for the intrinsic value, there's none, and for the extrinsic value or the time value, there's 7. So not only do you need the stock to go up, but you need it to go up by more than 7 by expiration to make up this extrinsic value. So watch what could happen. Let's say that our stock is trading here for $100, and you buy this $100 call for 7, and it rises to 105 at expiration. Well, your $100 call is trading for $5 of intrinsic value, and therefore you lost $2, even though you were correct that the stock price went up. What if the stock price rises to 107 at expiration? Well, now your $100 call is worth $7, and because you paid 7, you just break even. What if the stock price rises to 110 at expiration? Now that $100 call is trading for $10 of intrinsic value. Because you paid 7, you made 3. But notice, had you purchased the shares, you would have made money with the stock at 105, 107, and 110. But by purchasing the option, sometimes you lose, sometimes you break even, and sometimes you make money, even though it's the same stock rising to the same levels at the same time. And that's because options have a speed component to their prices. So how can you reduce this need for speed? Well, a real basic tactic is to simply buy in the money options. put some intrinsic value in them, and therefore you will reduce the extrinsic value. So in the money options have very little extrinsic value, at least relatively speaking. And the smaller that extrinsic value, it means that traders don't need large aggressive moves in the underlying stock to make money. So if you're trading in the money options, then they become more like a directional play, like the stock. So for instance, let's go back to our stock that was trading for 100, and instead of buying the $100 call, the at the money, maybe you buy the $90 call. Now yeah, it might be trading for 12, and that's a lot of times what makes traders a little fearful, and they say, oh, it's so expensive, but they don't realize it's all intrinsic value, or at least largely intrinsic value. With the stock at 100, this has $10 of intrinsic value, which is just cash, and it has $2 of extrinsic value. So now I don't need the stock to rise as quickly or as far because I just need to beat $2 of extrinsic value. I just need that stock to rise at least $2 by expiration just to break even. See, when I bought the at the money, I needed it to rise 7. I needed a fast, aggressive move to make money. So for instance, let's go back and say that we've got the $90 call trading at 12, but now the stock goes to 105. Well, now that call's trading for $15 at expiration. If we paid 12, we made $3. If the stock goes to 107, that $90 call is trading for $17, in which case we made 5. And if the stock is trading at 110, the call is trading for $20, in which case we made 8. So notice what happened here. We've got the same stock prices, 105, 107, and 110, and we made money in all 3 of those cases. And of course, anything in between. But see, that wasn't true when we paid 7 for the $100 call. Because of that, we needed a very fast, aggressive move before we could make money. So what's the point to take from this? Well, if you are new to options, understand that you are primarily trading direction. So if you're new, use in the money options to reduce the need for fast, aggressive stock moves to make money. In the money options are far more about the direction of the stock, which makes them very similar to stock. Not exactly, but a lot more similar. And that means you can make money for being right about the stock's direction rather than the speed in which it moved. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab, as well as a brand new technical analysis course for 2021. You can also join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.